Hello to everybody, dear customers. Future Trend channel is glad to welcome all of our subscribers, and today we'd like to concentrate your attention on current slump in the value of shares of United States banking sector. We'd like to answer the question: what was the reason of the current slump of the stocks of United States banks? What are the roots of such kind of problems? Also, we'd like to understand what could happen in the nearest future with such kind of stocks. And first of all, we'd like to present you the so-called KBW index. Probably the benchmark stock index for the banking sector in the United States that lost for the last 3 months around 11%. And as you know, the KBW Bank Index, developed by financial sector specialist investment bank Keefe, Bruyette and Woods, includes 24 banking stocks. And as you could see, beginning from the start of 2018, the value of this index lost from the highs of 116.5 to current levels around 104. As you could see, it was below 104. So the same applies, by the way, for major United States banks. For example, the Wells Fargo probably is an excellent example of this kind of slump. Beginning from the start of 2018, the value of Wells Fargo stocks declined from 66 to below 51, so as you could see, more than $15. Now the stocks of Wells Fargo slightly rebounded, but at the same time remains into negative territory. Probably some other United States banking stocks was not so bad during this period of time. For example, the Bank of America corporation declined not so hugely. For example, the shares of this bank declined from 32.70 starting from beginning of March, from 32.72 to current kind of level of 28.28. Also, probably the same applies for Citigroup, which at the moment trading around 67.16 against the highs of beginning of 2018 registered above 80. So let's understand such kind of problems, and let's answer the question: why United States banking sector is in such kind of slump at the moment? As you know, investment in United States bank stocks are declining for 2 weeks in a row. The longest decline in 20 years, by the way. So what worries investors, and why United States bankers lose the customers? As a result of the investment slump in investment funds specializing in banks, as we told already, the KBW index for 3 months lost 11%. The total capitalization of the United States financial sector players for 6 months fell by almost a quarter. Here we should understand the situation basing on 2 segments of times. The first one, Obama times, and the second one is current Trump's times, the times of current United States administration. As regarding the Obama times, the first blow to the country's banking sector was inflicted a few years ago when the Federal Reserve leaders carried out a large-scale redemption of bonds from market players, the so-called quantitative easing. It was assumed that the proceeds from the sale of debt papers would go into industrial sector. Hopes were dashed anyway. The corporations simply did not find enough interest for capital investment inside the country. As a result, part of the money received under quantitative easing went to stock speculation, dispersing stock indices to record values. The lion's share of the funds remained in accounts in anticipation of better times. For banks, this meant that customers had less need for credit. Over the past 2 years, the volume of lending in the industrial sector has increased by only $100 billion. For comparison, in 2 years after the crisis from 2012 to 2014, the volume of loans to the industrial sector increased by $220 billion. Accordingly, the income of banks from interest on loans has significantly decreased. Now, let's see and let's understand the current situation. The situation with the Trump times. A strong blow to the financial system in this situation caused the trade war. Immediately after Trump announced import duties on steel and aluminum at the end of March, the KBW index fell by 7.3%. Experts emphasize that the sale of securities began in China, in the Shanghai and Hong Kong exchanges, and then spread to the stock exchanges of the United States and other countries. Investors reasonably judged that in the context of trade war, corporations would prefer to refrain from new credits, and that would negatively affect United States banking industry. Fears were confirmed. The head of the Fed, Jerome Powell, on June 20, at the banking conference in Portugal, said that American companies are already putting off investments and reduce hiring of new workers because of fears of a recession in the economy. According to expert estimates, trade wars can slow gross domestic product in the United States by 0.3–0.4% this year. And this is an optimistic forecast at first glance. Another factor is the monetary policy conducting by the Fed. In March, the key benchmark interest rate in the United States, the so-called refinancing rate, was increased by quarter point and by the same amount in mid-June. And the public debt continues to grow steadily. It's already around $21 trillion now. Congressmen in the United States suggest this problem should be resolved within 10 years period. If not, then the credit bondage will finally strangle the country's financial system. Some even believe that the point of no return has already been passed. The country spends more than it earns and has to borrow money. Structural deficit creates a gauge effect. I think we are moving to the abyss. These are not our words. These are the words of Congressman Andy Biggs. Unlike Biggs, Wall Street's analysts are not shy in their expectations. In particular, the world-famous investor Jeff Gundlach, who predicted the crisis of 2007, commented on the increase in the interest rate with the increase in the federal budget deficit, at the moment $1 trillion. He commented by the expression, "What we are doing is like an economic suicide." And The strengthening of macroeconomic risks leads to an increase in the cost of borrowing for the United States government. United States government bond yields are at record high levels. Until recently, it even helped American banks rush to buy debt securities with high yields. As a result, financial performance improved slightly in May and early June. As you could see that on the chart, the KBW index increased by 110.83 that time. However, the White House's announcement of its intention to introduce new trade duties on July 6 sent bank shares to a protracted slump, which is still ongoing. Another problem that's facing United States banking industry and also the United States dollar itself is the so-called and very, let's say, spreading at the moment expression of unnecessary dollars in the future. Now the most likely scenario is the sharp devaluation, for example, of all of this situation, of all of this kind of problem with trading wars from the part of China, which is probably the most victim of such kind of trade battle between the United States and other parts of the developed market. Now the most likely scenario from the side of China is the sharp devaluation of the yuan against the dollar, an asymmetric response to the new United States duties from the part of Beijing. So the prices of American goods in the world markets will increase compared to Chinese ones. Therefore, companies have even less reason to take out loans to expand production. In addition, the prospects of refuse of many countries from the dollar and international payments are on the rise at the moment. Accordingly, the need for dollar-denominated trade credits will weaken dramatically. In other words, United States banks may not be needed in a beautiful new world based on protectionism and local currencies. Of course, probably we underestimate this situation because we are living in a, let's say, minding of short-term period of time. But in the longer term run, the situation could dramatically change for the worse side for the United States banking sector, and not only for the banking sector, but probably for all the corporation sector of the United States and other developed countries. Thank you very much for all of your attention. It was Future Trend Channel with you. Bye bye for now.